Hello, economics students. We've been talking about corporations quite a bit over the last several days, and today I want to continue our discussion of corporations and this form of business organization by looking at the advantages and disadvantages of organizing a business as a corporation. You'll notice that there are some similarities to what we've already discussed as far as advantages or disadvantages with proprietorships and partnerships, only this time it's sort of a mirror image or an opposite image of what we've seen in other types of business organizations. First of all, with a corporation, and this is hugely important, there is now limited liability. You'll recall that with a partnership and a sole proprietorship, you had unlimited liability. Well, limited liability in a corporation reduces the risks for investors, and by investors we mean the people who buy stock. And this makes purchasing stock a very attractive investment for people who have the means with which to make a sizable investment. The most that you can lose if the corporation goes bankrupt or does something that is bad, the most that you can lose is the value of your stock. Okay, you cannot lose everything you own like you could conceivably do if you owned your own business as a sole proprietorship. So you can only lose the value of your stock, and that's it. That limits your liability. Corporations also allow ownership without expertise. I can go buy stock today in Caterpillar, and I know nothing about large construction machinery. I don't need to know anything about large construction machinery. I can own a piece of Caterpillar without any knowledge of that business whatsoever. So corporations do allow ownership without expertise. You can buy stock. You don't have to know about that industry to buy that company's stock. There's also ease of transfer, and by ease of transfer what we mean is it's easy to transfer ownership of the corporation. In other words, it's easy to transfer ownership of stock. If I buy stock in a corporation today, I can easily sell it later in the day or tomorrow. That is ease of transfer to buy and sell stock. It's as easy as can be. Corporations have a much easier way and a much greater ability to raise funds. We talked about that as a disadvantage of proprietorships and partnerships, how difficult it can be to raise funds. That's not the case with corporations. Corporations will oftentimes simply issue more stock, and they'll sell more stock to raise funds. A bank is much more likely to lend money to a corporation than they would be to a proprietorship. You can also issue what's called bonds, which is another kind of debt. Bonds, B-O-N-D-S. That's a type of debt. Corporations do this a lot, and it's an easy way again to get low interest loans to finance whatever the corporation needs to finance. And finally, a corporation has unlimited life potentially. We saw how there is still an active corporation that was founded in the year 1347. The oldest corporation in the world. The oldest corporation in North America is still active. It was founded in 1670. The Hudson Bay Company, still doing business. So corporations can potentially have unlimited life as long as they continue to operate in a profitable way. Of course, whenever you have advantages, you also have disadvantages. So let's take a look at some of the disadvantages of corporations. First of all, expense. It is costly to get a corporation organized and up and running. Remember, you have to get a charter, and you have to file that charter with a state. That is a fee that you have to incur, and it is not cheap to issue that charter. It's a very costly process to get the corporation up and running. Loss of control. A good example of this would be Apple Computer. When Steve Jobs founded Apple Computer, he founded it as a proprietorship, or later I think it became a partnership. Eventually, Apple was incorporated. And when Apple became incorporated, Steve Jobs lost control of his company, and control was given over to the board of directors of the company. After several years, the board of directors actually fired Steve Jobs from Apple, And so he was fired from the company that he started. He lost control. Now, when Apple's board of directors fired Steve Jobs, that actually hurt Apple in the long run. And after a while, Apple became a less productive company. Their stock started declining in value. And eventually, the board of directors hired Steve Jobs back. And as a result, he brought a lot of his creativity back to the company. And now we know that Apple is the most valuable company in the world, much largely due to the fruits of labor that Steve Jobs put forth in the early part of this century when he was hired back by Apple. But ultimately, though, he did lose control, and that happens to anyone who incorporates. If someone owns a company and they incorporate, they will lose control, and that control will fall to the board of directors. Taxation is an issue, and let me discuss why. First of all, a corporation has to pay income tax on its earnings. Now remember, if you are a stockholder in a corporation and the corporation pays income tax, that reduces the profit that you're getting in the company that you own. And in other words, that's going to have a drag on the value of your stock, that corporate income tax. In addition, stockholders have to pay income tax on any dividends that the corporation gives them. Remember, corporations will oftentimes take a part of their earnings and share it with their stockholders in the form of a dividend. When you receive a dividend check, you are taxed on that as a part of your income. And you will also be taxed on the increase in the value of your corporate stock. That's called a capital gains tax. So not only do stockholders have to incur the tax on their corporation's income, which reduces the profitability of the company, but they also have to pay their personal income tax on the dividends and the increase in the value of their stock. So it's kind of a double whammy for stockholders as far as taxing is concerned. And then you have lots of regulations. The SEC, Securities Exchange Commission, regulates corporate behavior, and they can be pretty aggressive in that regulation of corporate behavior. You have to file that annual report, and annual reports can actually be used by a corporation's competitors. The annual reports talk all about the company's business and its profitability, and a competitor is going to look at that information and go over it with a fine-tooth comb, and they can then formulate their own strategies and tactics in their industry based on what they learn about their competitors through that publicly published annual report. Okay, so those were some disadvantages. Now, let's look at some controversies that surround corporations. There's a lot of talk these days about how corporations have become too big and powerful. You know, Apple Computer, its income is a lot bigger than the entire productivity and gross domestic product of certain countries in the world. You know, they make, billions and billions and billions of dollars more than what is produced in small countries. So this has made corporations very, very strong and powerful. Some of them are very, very big. There's also discussion about the boards of directors. The board of directors, as you've seen, are not directly employees of the corporation. But what happens is you will have situations where the board of directors may be looking out for their own interests more than the interests of the shareholders or stockholders. For example, let's say that you are AT&T and one of the members of your board is a high executive at, at a railroad company. And then that railroad company might have the head of AT&T on the board, on its own board of directors. You have this situation where maybe these boards of directors are looking out for their own interests. So if AT&T has a bad year, maybe the board of directors will be hesitant to, say, cut the pay of the AT&T directors or the AT&T officers because those same AT&T officers might be able to cut the pay of the officers at the company where the director is a direct employee. So it's this weird symbiotic relationship of these directors at multiple companies that are all kind of related. They all are ultimately, related to each other as they all are directors on each other's companies. And so maybe these directors are looking out for their own interests as much as, or even more so than the interests of the shareholders. And that might be an explanation as to why the officers of these large corporations make so much money, huge amount, millions of dollars per year. And they're hesitant to cut their pay, and maybe that's the reason why. Do corporate executives make too much money? And that's sort of related to what we were just saying. Corporate executives make a huge amount of money. And the difference between what a corporate executive, say the CEO or the president of a large corporation, makes, a corporation like I don't know, IBM, look at their salary and compare that to what the average worker makes at that corporation. The difference between the executive salary and the salary of the average worker has gotten larger and larger and larger. The corporate executives are making more and more money, while the salaries and wages of the low-line workers at the corporations have remained pretty flat or grown just a little bit. So there's a lot of controversy related to that very, very high executive pay compared to what the workers at the companies make. And then, do corporations have responsibilities to, excuse me, pardon me, do corporations have any responsibilities to anyone other than the shareholders? Shareholders obviously are who the corporation's directors need to be looking out for, but what about the employees? Do the corporations have responsibilities to its employees? Does the corporation have responsibilities to the community where they operate? And we're going to be taking a look at that in the next day or two to see whether or not corporations should just be looking out for the interests of stockholders, or do they have a larger interest, a larger social interest, looking at the interests of lower level employees at the corporation and the communities where they operate. So we're going to stop there. We don't need to go to other types of business organizations just yet, so I'm going to back out of that. And that will be it for today. Check Canvas to make sure there is or maybe not an assignment there for you. I'm not sure. And with that, I'm going to close this presentation. You guys have a wonderful day.